So the Fed just boosted their Fed funds rate another 0.75%. And I'm already seeing some chatter on social media and seeing the misinformation. And I want to get ahead of that right now. So, what is the Fed funds rate? And then how does it affect you, your finances, and wanting to purchase a house right now or this year, the near future? So, let's take a look at that. So, yes, the Fed just announced that they boosted their Fed funds rate by 0.75%. And let's remember the Fed funds rate is not mortgage rates. Okay. So the Fed funds rate is the overnight or short term loan rate that banks use to borrow money from each other. It will affect your credit cards, your home equity line of credit, and bank loans, those types of things. Okay. And so, what they're doing right now is getting ahead of inflation, trying to curb inflation. And mind you, they're late to the game on this. I feel like they should have been doing this when inflation was tiptoeing at 2%, somewhere right around there. But nevertheless, they're pretty aggressive on curbing inflation right now, and that's what we're seeing. So I want to show you what mortgage interest rates have done since they got serious about curbing inflation and how the market likes that. The market already is reacting favorably, the stock market, the bond market, to this news, and we're already seeing gains in both markets. So I'm going to show you what that looks like. To do that, I'm pulling up the 30-year bond chart here, and I want to go back to January of this year. So just to give you a snapshot of where we are coming from. So back in January, and we all know February, March, April into May, there was a significant increase in interest rates, a little over 2%, depending on which snapshot timeline you look at. And so back in January, you can see we've had this sort of slow dive to January 14th. And then on the 15th, the Fed announced, hey, we're going to get serious about, curbing inflation. We're going to boost our Fed funds rate. And the market reacted to that. So let me zoom back in here real quick and show you what I mean. So this is June 14th, and this is the 15th when they decided to boost interest rates. And now, with the bond market, when the bond market is moving down, interest rates are moving up. Now, when the bond market is showing gains and it's moving up, the pricing on interest rates are coming down. So right now, we're super favorable now than we were even a month ago. So you can see as the bond was getting, we're increasing in gains here. Interest rates were getting better. And then we were kind of riding along this. It's the 25-day moving average here. And we just kind of played in between here. And then this was today. This is the news. So we were, right between this floor support, and this is the 50-day moving average. We broke through here, and now the bond is reacting. People are liking that the Fed boosted the Fed funds rate. And, we can ride this all the way to the top of this ceiling here. But if we break through this, we have this territory for gains as well. And then we got to break through the 100-day moving average into the next, these are called Fibonacci levels, into that. So the more you see the green and the more we rise here, it's favorable for interest rates. And that's going to happen as the Fed keeps boosting their Fed funds rate. And so that's what's happening right now. And so I wanted to just show you, hey, by them boosting the rate, mortgage rates are not 6-7%. They're not adding on to mortgage rates. And so this is how mortgage rates, do react, or this is how the bond reacts. And this is how the Fed funds rate, inadvertently affects the 30-year bond and mortgage rates. Sorry, I've been talking all day. And so I wanted to show you that. And the other thing too that's interesting, I know there's talks about recession and all that stuff. And so back in March, I did a video on inverted yield curves and how they have, pointed to the last 7 recessions. They've actually predicted the last 7 recessions when those yield curves go inverted. And so what that means is if you and I were investors in mortgage-backed securities and we want to take that long-term, the 20 to 30 year, let's say, at 4.5 or 5%, we're putting our money into these bonds. And for 30 years, that's our guaranteed rate of return. Well, inflation erodes that buying power. It erodes that 5% because it's, 9.1%. And so it's totally eating away those gains. And so what happens is you have the 2-year treasury, a 10-year, and the 20 to 30. And so the shorter term treasuries are a better investment. They're showing better yields than the long term. And so that's where the inversion comes from. And let me show you real quick what I mean. So a 2-year is yielding at 2.98%, and the 10 years at 2.78%. And so that's where the inversion happens. And that's one of the indicators of a coming recession, 2 negative quarters of GDP. And, so everything is pointing towards that happening. And so I'm going to be watching these charts for you very carefully. I'm going to show you how to navigate this and, get through this recession and kind of what's coming on the other side of that, the opportunity. Because if you navigate this correctly, you can set yourself up to do great things, especially if you want to purchase a home. So leave your questions in the comments. I'll answer them there. Give a like to this video, share it if you found it valuable. But again, all this to just bring some clarity, because I feel like there's a lot of unnecessary anxiety surrounding the Fed funds rate. And the more people that understand this, we can help curb the anxieties and, not be dream killers. So I'm Jeremy Baxter, Wallach and Volk. Go ahead and share this. Again, please share it with your friends, give it a like, and let me know what questions you have, and I will answer them in the comments. You guys have a great day, and look forward to talking to you again, and watch for my next video. Bye.